Rissmiller. I'm the GIC chair currently, and it is my pleasure to welcome everybody to the 10th annual Rocky Mountain Economic Summit. We're very happy to be back here. I think it's been a forum where we've had some great discussions in the past, and we look forward to another good year this year. I'd like to thank the Bronze Buffaloes for putting this together, and also Otterbox, our sponsor. They have a tent set up outside with a number of gifts, and there is also a VIP suite located between the restaurant and hotel for relaxation. So please check that out. So I thought I'd start out with a little bit of history. David Kotak is here, so I thought that would be appropriate to tell you a little about the GIC history. So in 1976, there was a big celebration of American independence. And that certainly is something that's relevant today. At the same time, there was a group of forward-looking individuals, so back in 1976, who thought that while we were celebrating independence, it might make sense to also talk about interdependence in the global economy. And I think with the events that are going on currently, that is increasingly relevant, and that's one of GIC's missions, is to convene in a neutral setting, dialogue, not to advocate any particular position, but to try to create an environment where everybody can take away some sort of educational material, and we look forward to doing that again here today. Let me tell you, if you check out interdependence.org, you can see some of the upcoming programs. I would highlight one in particular, which is a unique one. There'll be a trip that's being planned to Cuba for early 2019. We're probably going to have a maximum of 20 people that we'll be able to take. There are 4 slots left, so I want to announce that to the group here. You can see Jill Fornito in the back there if you'd be interested in that trip, but I think we're getting a pretty robust group together to make that voyage, and we'd love if some others could join us, but those slots are going quickly, so please check in with us if you'd be interested in something like that. Please check out the website, interdependence.org, if you'd like to see more about some of the other upcoming programs. So let's kick it off today then. We are convening in an environment where there is significant trade tension. There's currency volatility in emerging markets. There's concern about peak earnings growth from some sources in the financial markets. There's valuation concerns. There's questions about how tax reform is working. There's some cooling data in the European landscape. We've had a flattening yield curve. We've had social media companies go to Congress for regulation talks. We have investigations going on in DC. We have Brexit still going on abroad. So I think it is a very timely conference. Our first panel is going to talk about the international economic outlook. So let me bring up Bill Strauss from the Chicago Fed to introduce our first set of discussants. Thank you.
All right, good morning, everybody. And Don, thank you for welcoming our people here. So we're going to start off talking about the global economy, focusing on certain parts of it. We have 3 great panelists to talk with us, share their views, and they all have the title of chief economists. I'm not going to run through their bios. The bios of not just this panel, but every speaker up here appears in the program. Hopefully you've picked up one by the name table. And so we're going to go in a little bit different order than what's reflected on the program. We're going to start off with, and if as I call their name, if they would come up here and take a seat at the panelist table here. We're going to start off with John Silvia, Chief Economist from Wells Fargo. I was kind of getting on John's case this morning because he didn't quite get into the uniform of an economist, but understandably so. On Monday, John announced formally that he will be retiring from Wells Fargo at the end of this month. So we're really honored to have John join us to talk about how the U.S. economy is going. He will go first. Then we'll have that followed by Michael Drury, who is the past chairman of GIC, but also chief economist for McVane Trading. And he will focus on China, the second largest economy in the world. And then, doing no small part, we'll have Megan Greene from Manulife, who is going to basically talk about the rest of the world, as well as throw in a few comments about the top two economies in the world. They will each have 15 minutes for their presentations. That will leave us about 15 minutes for Q&A, so please take notes as they're going through. We'll take questions again at the end of all three presentations. So with that, John.
So I love this little brochure that the Outer people have put out. There's a little sentence here about outside is not a club. And there's a sentence here that says, but lately it seems like there's a right and a wrong way to be outside, as if the only way to pursue a passion is the way someone else pursues theirs. I thought that was really great, fitting into the concept of an entrepreneurial meeting like this. It's not only economics, but entrepreneurial. My latest lesson in this one thing about there's not one way to do it and there are other ways to do it is for those of you that had an opportunity to go out to the Equestrian Center the other day. I was fascinated by Cody's explanation about how to train a horse. May seem very different, maybe very odd, but you could see how he looked at the traditional way that people were training horses, and he said, you know, that doesn't work the way I would like to train the horse. And after a few minutes of demonstration, it was amazing to see how well trained this horse would be with Cody, and I was really impressed. So I don't know if Cody's here or not, but that is an excellent representation, Cody. That's an excellent representation of entrepreneurial spirit applied to something that we don't traditionally think as a business activity. So that was pretty cool. So this is the dollar. As you can see, it's had its ups and downs and changes over time. And I think, once again, what was fascinating about the dollar is how much the dollar has changed in terms of its relative value compared to our 7 leading trading partners. And some of you have heard me speak before. I find it's fascinating, first of all, when you look at who the 7 major trading partners are for our exports. 3 are in Asia. Now, someone like me growing up in Massachusetts, I took a course called Western Civilization because that was the only civilization that there was. There was nothing else in the world. So it's always fascinating to think about the fact that in the 21st century, we're dealing with 3 countries in Asia that are among our top trading partners. And we need to be very aware that what we may have thought of as the great America of the 1950s, 60s, and 70s is a very different place than where we are today. Most of the economic research that I do only goes back to the 1982 period. That's my starting point, because for us, with time series analysis, there are so many structural breaks in the late 1970s, early 1980s, that's where we begin our analysis. So in terms of perspective, in terms of being entrepreneurial, here, again, looking at the opportunities of where we are. And our top 2 trading partners are Canada and Mexico. So, you know, when I hear about, you know, is NAFTA going to survive? Of course it has to survive. It's like any business agreement. It changes over time. but there's no way you're going to get rid of NAFTA. It's our top 2 trading partners, folks. So again, when you're thinking about perspective and where the opportunities are, and then again, 3 are in Asia as well. And then focusing on, what is the problem? Many of you running businesses oftentimes have to figure out, okay, where is our problem? What is the problem that we have to face? And when you look at this graph, you realize, I'm looking at trade balances for Canada and Mexico. That's not a problem. That's not where the issue is. The issue is, again, primarily with respect to Asia and how we trade. And many of you are pretty familiar with the challenges of figuring out where is trade actually being produced and where are goods actually made or shipped. And so where their final shipment is, oftentimes from China, is not actually where a lot of the goods are actually made. And they're made in other parts of Southeast Asia. So there's a concept called value added. And if you want to see some of those graphs, we can send them to you as well. So here again, South Korea is a great example of this. They send more exports to China by twice as much than they send to the United States. So to lecture South Korea in terms of their trading behavior and what they should be doing, we're not the most important trading partner they have. So again, perspective in terms of the global economy and trading relationships, I think, is absolutely key. So this is where we ran into problems. You can see that in a model, as economists oftentimes do. We're looking at the exchange rate as some function of interest rate differentials. And that is a very simple model. But actually, when you look at the graph, you realize from about 2012, 2011, up until, basically mid-2016, 2017, that was okay. As interest rate differentials rose, the dollar rose. But then you can see the breakdown. And then you start to say, okay, what has interrupted? What has changed our model? And for economics, it's very important to try to understand when those models start to break down and when you can't rely upon the very simple relationships that go on. But also, as many of you as portfolio managers can probably appreciate, when you're running a portfolio, it's very, very challenging to get out of simple boxes. One of the challenges I have as working at a big institution is, we have an exchange rate team, we have an interest rate team, we have an equity team, we have a credit team. We have all these teams coming, and then you have to stop and think that there's a huge interaction going on. So here you can see an interaction between the credit markets, interest rates, and the exchange rate market, the dollar, and how that interaction may have changed over time. It's absolutely critical. Central bank policies, this is what our expectation is in terms of what the different central banks will do. And you saw the Bank of Canada just did raise its interest rates over time. Here's, again, a challenge we have because we, as many of you do over time, have a sense that there's a changing fiscal policy going on within the United States that now is having implications with respect to exchange rates, interest rates, and Fed policy overall in the Fed's balance sheet. So once again, thinking about the interactions that go on between the different markets, absolutely key for what we do. So again, U.S. bank treasury holdings, domestic ownership, how is that ownership changing over time in terms of who buys this stuff and who sells this stuff over time? The net purchases of U.S. treasuries, again, trying to understand where the demand and where the supply is for all the different treasuries and who's buying this stuff. And look at the foreign official versus purchases, a big change over time. And so in the context of rising treasury deficits in the next 3 to 5 years, who's going to buy this stuff? And again, as an economist, one also adds, you're going to buy it at what price? Many of us know, and again, the impression I have oftentimes is that the original owner, producer, developer has a certain sense of what the price is, but finds that it doesn't really work and they have to change the price. So it isn't a question of we're going to sell more debt and everybody's going to buy it. Yes, okay, they'll buy it, but at what price? At what exchange rate are they going to buy? And that's what a portfolio manager really has to worry about. Okay, yes, I have an IPO. We are going to sell all those shares, But are we going to sell those shares at $10 or $5? And it makes a huge difference. And I think that's one of the challenges we'll have in financial markets in the next 5 to 10 years. At what price are we going to sell all these treasuries? And the price is not only the interest rate, but also the exchange rate over time. Foreign purchases, this is our interest rate forecast. And again, global economic growth in terms of where it's going, export volume. And here, again, I think it's really fascinating. It's not simply we have a trade deficit. And for me, to argue that the trade deficit is sort of like something we need to get to zero or anything like that is kind of ridiculous. But what I'm really interested in is who are we actually exporting to? Who's buying our stuff? And when you look at, excuse me, the graph, you realize it's important to distinguish our exports to developed markets and developing markets. And there's a huge gap there in terms of the differences in terms of who we're selling to over time. So again, that little nuance, that little subtlety, getting below the headline that you oftentimes see in the media and saying to the next level, what's going on at that next level? You know, who are we really exporting and importing to? And you can see here, in terms of durable goods, capital goods, we export an awful lot more to developing markets than we do developed markets, especially in capital goods. So when you're thinking about industrial machinery, earth-moving equipment, right? I'm not allowed to name names, but when you look at individual, what is being done, what do people really need, we sell an awful lot more to developing markets than we do advanced markets. So again, our trading relationships are far more complex than you might see in the top-line media. Here's our economic forecast overall. So I didn't mean to go really, really fast because, again, following these graphs can be a little bit challenging. Any of these graphs can be updated over time. I probably will not be the one updating them in 2 or 3 months. But I can assure you all of these graphs are on our public website, and if you contact someone at Wells Fargo, they'll be glad to update them for you. So I think, again, just in quick summary, when you think about trying to be the entrepreneur, trying to be the portfolio manager, the given path that's out there is what everybody else does. And you, like, you know, Cody has to figure out, how do I do it differently to really make a difference in the performance of what I want? And for me, it was quite impressive when I was watching Cody ride that horse and like, wow, that kid knows what the hell he's doing. So I thought that was pretty cool. So thank you.
All right, marvelous, John, and 25% reduction in your time allotment, so we're doing well. So Michael, you're up.
All right. Get pictures here. There we go. Oh, I'll go back one. So I'm going to talk about China for 15 minutes, which means I'm going to talk really fast. No. I'm going to do this in like 3 pieces: where China is now, where the tariffs might, impact, and then what China really thinks about, which has nothing to do with tariffs and is much longer term and strategic. I look at China as a roller coaster, a 3-year roller coaster. It's a boom-bust 3-year inventory cycle like the United States economy was back in the early 1900s. In many ways, because I come out of an agricultural background, it basically is a 3-year corn hog cycle. And the biggest movement in prices there is food prices. Well, if you can see from this chart, it bottomed in 06, it bottomed in 09 on Lehman, it bottomed in 12 on the European crisis, it bottomed in 15 on the Chinese-owned corruption campaign, and now it's bottoming in 18. And the question is, how far down does that bottom go? Now, this is residential real estate, which basically drives the economic cycle, but it's simply a reflection of the fact that China moves on a massive credit cycle. And you can see the boom in 09 that took you from just over 500 to just under 1250. I mean, so that's a more than 100% increase in credit, and then it moved sideways. Then you had another boom from 100 to 150, so that's only half as big. That's a 50% increase. And now this latest boom took you from 1250 up till about 1600, so it's about a 33% increase. And as you can see, the tailing off from this one is much more violent than the tailing off from the last two, as they're really trying to rein in credit in China. Now, a huge problem with credit in China is we don't know how much there is. We really don't. I mean, everybody talks about debt to GDP numbers, and you can measure the debt and you can measure the GDP, but what you can't measure is the layering. Because if I borrowed the money from Don Rissmiller, and Don borrowed it from Ray Dillon, and Ray borrowed it from Bill Strauss, and Bill Strauss borrowed it from somebody else, I mean, you could count that same debt 10 times. In the United States, that makes a difference, because if one of the dominoes falls, it tends to ripple through the system. You get bank crises, bank runs. In China, if Don Rissmiller defaults on or has a problem and there's a debt issue, the government just comes in and says, Don no longer exists, you owe Ray Dillon the money directly. So the layers of credit can be eliminated very quickly, and that's what's going on right now, is you're seeing a lot of these debt-to-equity swaps going on, and you're seeing a lot of equity ownership having to be called in to pay down debt. So we don't really know how much there is, so we don't know how sensitive they are. This is a chart that I neatly stole from Don Rissmiller and Strategas, and the bottom line is basically what it shows is that shadow banking slows down at the same time that debt slows down, because it's entirely a high-end issue. The people who are being hit by the credit slowdown in China can afford it. I mean, the country has like a 50% savings rate, and the people at the top have huge savings rates, so there's huge buffers at the top to be able to absorb this kind of shock. Now, where is China? This is, we call this the Li Keqiang Index. So you basically look at bank loans, which I showed you were slowing down, electricity use and rail traffic, which have both started to turn back up. So there's some question as to where China is in the cycle. Now, they'll always tell you they're growing 6%, but I estimate they were at 9% at the start of 17, and that they're probably south of 5% now. I would have thought they got all the way down to 3%, which is kind of their normal bottom. But because of the trade war, it looks like they may be stimulating their economy earlier than we had anticipated, and we're already starting to see something of a turn. You can see it in the imports, the blue line as well. Imports always turn up ahead of exports in China, and imports have flattened off to turn slightly higher. They never really had a crack in here. All of this is critical as to what happens to the yuan. The yuan is important for China because it's their buying power. They're a huge commodities purchaser around the world, and most of those commodities are priced in dollars, so a strengthening yuan has actually imported deflation to them. And so they had a huge run-up in the value of the yuan at the beginning of the year, so large that China in the 12 months, in the 4 quarters ended the first quarter, grew by Brazil. Right? They grew from just under 12 trillion to just over 14 trillion in 12 months. Brazil's a $2.2 trillion economy. They grew that. Well, they just gave half of it back. So they lost Mexico in 3 months. So the volatility in interest rates in the currency is critically important. It's most important in my business because the single most important number that I look at is nominal GDP in China measured in dollars. And that had been soaring from the middle of 2016, beginning of 17, to a peak that was probably right now. And if I run the numbers forward based on my expectations for GDP growth in China over the next 6 months, you can see that that slows down from a very hefty, almost 20% growth rate back down to about 10. That's still pretty fast, but the reason that's important is that that same pattern is the pattern of the price of every commodity in the world. China is the largest purchaser of commodities, paying in dollars, and as its buying power increases and decreases, its ability to increase and decrease volumes goes up and down, and you can see it in the price of everything. The only exception is crude oil. You can see all commodities peaked back there in 2011. The copper chart's very consistent with other charts, and then it came down, 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 down into 2016. That was all happening because you peaked at the tsunami in Japan. The only thing that didn't do that was oil, because the same tsunami knocked out barrels of oil to Japan and they had to be replaced by fracking from the United States. Well, now again, oil is the laggard. Oil prices north of $70 a barrel are very high compared to minerals and metals prices now, which tend to be on their lows right now. And for gamblers, that's probably the best commodity spread in the world right now, is to be short oil and long metals. I didn't say that. In terms of the tariffs and what it means for China, well, you can see back here, if you look at the blue line, at the peak of the last economic cycle in 2007, China was a mercantilist. It was about a $7 trillion economy. It was about 25% of the United States at that time. It was growing at about 35% in dollar-denominated terms. It was buying every kind of commodity on the planet, and it was running a 7 to 8% surplus on its trade balance. Today, it's running just about 3% and falling. And of that 3%, you've got basically 18% imports, 15%, or 18% exports, 15% imports. Of the 18% of China that's exported, the United States is 15%. So 15% of 18%, you know, it's not a big number. It's a doable number. It's a number that's well under 1% of their economy. So while the Chinese will not enjoy a trade war with the United States, they can survive a trade war with the United States. As John was pointing out, you know, the United States is not their largest trade partner. The EU is their largest trade partner, and Japan and South Korea added together are roughly the same size as the United States. Their largest trade partner is actually the ASEAN, the developing, less developed countries of Asia, which account for 55% of their exports. So to put the trade war in perspective, I mean, we've had a round now of 25% tariffs on $50 billion, actually $34 billion announced and another $16 billion coming next week. That's $12.5 billion. It's a number, but it's not a huge number in a $20 trillion economy for us and a $13 or $14 trillion economy for them. You know, if we double down like Trump says we're going to, and we do another $20 billion at 10%, that's another $20 billion, and so you're up to 32. That's a bigger number, but it's still not a huge number. To put it in perspective, first of all, of that $32 billion of announced tariffs, most of it will never be paid. For instance, I work in the ag industry, and we're already hearing examples of American companies going to ship beans to Brazil so that their crushers can crush American beans, and the beans that they were going to buy in Brazil, they will now sell on to the Chinese. So you avoid the tariff by transshipping. Your shipping costs are higher than they would have been otherwise, but they're not 25%. And nobody in America collects that tariff. Some shipper, well, maybe it's an East Coast shipper from the United States, but it's most likely an East Coast shipper from Brazil. So a lot of those tariffs aren't going to be paid, so the $32 billion number is not $32 billion. In the meantime, the Supreme Court ruled, 3 weeks ago, that you'll be able to collect internet taxes. That was worth $13 billion, the same as the tariffs. Trump announced this week that he wasn't going to make $10 billion in payments to Obamacare. The Fed is going to raise rates. President Harker will tell us about this in a minute. At least once, probably twice this year. Each one of those is as big as the tariff hikes. So the way I'm thinking about the tariffs is each round of tariffs is like a Fed hike. So if you do enough of them, then it's a problem if the Fed's tightening as well. But you can't crowd all of that into the economy at the same time. To put it in further perspective, I mean, a $5 move in the price of oil is bigger than any of the tariffs, and over 70 now, I think we'll be at 65 by year end. That probably offsets all of it. They're talking about indexation of capital gains for inflation. That's worth between 10 and 20 billion. So there's lots of 10 and 20 billions in the US economy. The competition is how important is trade versus the other ones. Longer term, the way China looks at the world is China right now is 13.4 trillion with the currency collapse that I put in there. That means it's roughly the same size as the Eurozone, and it's about 60%, two-thirds of the United States. I was at a conference, U.S. Chamber of Commerce in D.C., and there was a four-star admiral there who used to be the deputy of the Joint Chiefs of Staff. And he said, think of China as the largest private company in the world, and the United States is the largest public company in the world. Public companies have to answer to quarterly reviews and earnings reports and, you know, elections, things like that. Private companies don't. In my world, we deal a lot with Cargill, which is the largest private company in the United States, and they don't talk to anybody, and they don't tell you what they're doing, and they're very secretive. They're also very, very successful, and that's because they can think years, quarters, not quarters, but years, even decades ahead. And that's what China's doing. So what is China thinking about? Well, one, to put them in perspective, the east coast of China, which is the part of China that really matters to the trading community, is just under 500 million people, which is basically the same population as Eastern Europe. If you throw in Italy, Austria, Poland, if you come that far to the east. And if you do it by income, it's about the same. It's about 13,000. Italy would account for most of the high end, the Shanghai, Beijing. Austria has about the same income as Hong Kong. And that map's really interesting because Spain, Portugal, and France added together are Japan, and the UK is South Korea. So basically, that map of Europe is the same as most of the map of Asia in terms of income and interactions. Second thing to think about is this Silk Road that they talk about, where they're basically never going to be able to dominate the world with a navy the way that Spain once did, the UK once did, the United States is doing now. So what they're going to do is they're going to dominate a land mass. They're going to have high-speed rail moving all across Asia, all across Europe, through various routes into Europe. And they expect at the peak, somewhere around 2030, that they'll be able to ship rail traffic from the east coast of China, Shanghai, to the west coast of Europe, Madrid, Spain, in 14 days. Right now it takes 60 on the water. I mean, that's you won't have shipping on the water anymore if you can actually do that. Except to, what country can you not reach by high-speed rail? Which country would that be? And that's the way the Chinese are thinking. So they're not really thinking about the United States longer term. Now, the other big problem that the Chinese have is pollution, and their pollution problem is serious. And the Chinese think about this problem way more than anybody else in the world thinks about it, not just because the problem is so big, but because they believe in global warming. And they believe in global warming because the last time that China was at the absolute peak was back around 1300, and that's during a period that they called the mini ice age in the world. And it was a much cooler period of time. And the capital of the country back then was in Xi'an, where the terracotta soldiers are, which is way in the west because it was at the base of the Himalaya mountains where the runoff from the rain always gave you crops. Well, as the country warmed up, they moved east and they moved to Nanjing and Beijing. Well, that area now, if the global warming is really true and it warms up and you look at maps of what happens with 4 degrees centigrade, that's all underwater. That's 400 million people underwater. The Chinese don't think that's a good idea. So they're really very aggressive about these pollution control problems because they see it as a very long-term problem. The key reason that's important is that Tesla's just moved to China and is going to build a factory that makes 500,000 cars. Volkswagen and Germany are making a deal with China to make more electric cars. China makes 28 million cars a year and will make 40 million cars a year within 5 years. And more of them will be electrics. And they will be dictating how those electric cars are built. They'll be dictating the standards. And that's the real key of long-term planning, is if you're the biggest economy in the world and you're the fastest growing, you get to dictate the standards. And that's what the United States used to get to do. And that's really the trade war that we're in right now, is 10 years from now, who's going to be dictating standards for how trade is done globally?
All right. So I'm mainly going to focus on risks, since we've heard a lot about what we think is going to happen in the economy. But first, I'm going to start off just by saying what my baseline is, so you have a sense of what I think the risks are too. And I think the prevailing narrative right now is that in the U.S., but also across the developed world, maybe we've hit a structural break with this whole secular stagnation, low growth, low inflation, low rate environment that we've been stuck in since the global financial crisis, if not before. And so maybe the U.S. economy is starting to overheat. Maybe we'll get a late cycle surge in inflation. The Fed will have to catch up, we'll overhike, and we'll pitch us into recession. That's what a lot of my colleagues are really worried about. And I'm just going to explain why I don't really buy that at all. And I think generally, to give the cliff notes away to my presentation, I think we're all stuck around potential GDP growth. So for the U.S., that means we're around a 2% economy, which is a bit above our potential GDP growth rate, actually, because we've got more immigration than the rest of the developed world. Europe's kind of stuck around 1.5%. Japan's somewhere between 0.5 and 1% GDP growth. And I'm just going to explain quickly why I think we're so stuck. So there are two ways to fundamentally boost your potential GDP growth rate. One of them is to fundamentally boost your productivity growth. So this is a chart for the US, just looking at productivity growth. And you guys who have heard me speak here before know I never use PowerPoint presentations or charts, but I thought it might help frame my argument a little bit. You can see that productivity growth has just been incredibly low for a long time now. And this is a chart for the US that looks exactly the same if you do it for the UK, for Germany, for Japan. So this is a developed world problem. And if you disaggregate the different parts of productivity growth, you'll find that the biggest culprit is really capital deepening. So this has been kind of a CapEx less recovery. And I think there are two big reasons for that. One is just that, capital is so incredibly cheap. Labor is so incredibly cheap. Labor is kind of the new capital. So instead of companies going out and buying a huge, fancy, expensive new machine that they have to use for years, they can just hire a bunch of really cheap workers. And of course, they don't have to hire them all within their national boundaries. It's a globalized world now, for a while at least. And so they can just hire a bunch of cheap workers. They don't even have to pay health care in some cases, and they can lay them off whenever they want. So instead of engaging in capital expenditure, you're just hiring lots of people. And that's a double whammy, because then you don't get capital deepening, but also firms are hiring a bunch of cheap workers they figure they can lay off whenever they want. And so those workers are probably not the most productive workers on the planet as well. There's another reason we haven't had much capital deepening in this recovery as well, and it's a cynical view of mine. And that's just that the C-suite is paid in options grants increasingly off the back of regulatory change a couple decades ago now. And so they are paid options grants that are out of the money. And then they get a profit, and they can either engage in CapEx spending or they can buy back shares, and then their options grants are in the money and they can exercise them, pocket the proceeds, wash, rinse, repeat. And I just don't see either one of these trends really shifting much. So I don't see a whole lot of wage growth coming down the road, either in the US or more importantly in emerging markets. And I think there's room to grow or room to run in terms of cheap labor globally. China's urbanized and industrialized. Now India is. We've got the Middle East, Sub-Saharan Africa. There's a huge oversupply of cheap labor out there. And this issue about options grants and encouraging buybacks, I don't see that changing much anytime soon either. So I don't think the capital deepening piece of productivity growth is going to shift anytime soon. There's another way to boost your productivity growth, and that's technological innovation. And we've had a lot of that. We've been throwing tons of resources and energy and time at things like artificial intelligence, machine learning, quantum computing. We've made some progress, but for all the resources we've been throwing at it, it's been really small incremental progress. It's certainly not showing up in the data. And you could argue we just don't know how to measure this stuff, and that's certainly a piece of it, but I think it's really only a piece of it. There are a couple other reasons why technology might not be feeding through into the productivity growth data. If we think about what machines are really good at doing at this level in their development, they can crunch data much better than humans can. This is just an Alexa on the left. They're better at voice recognition and transcription, though they're not without their bugs. When I worked for Nouriel Roubini, Dr. Doom, I remember saying into Siri, I was writing something about my firm called Roubini Global Economics, and it automatically wrote down ruining global economics every time, with my favorite autocorrect mistake. But so there's certainly bugs, but they do it much faster than humans do. What machines can't do at all is discern between chihuahuas and blueberry muffins. And I stole this chart off of Dave Altig, who's at the Atlanta Fed, but they can't do that. So for all the resources that we're throwing at technology, we haven't gotten there. We're probably not about to get robots taking care of the elderly anytime soon. We will get there at one point, and at that point, you should see huge boosts in productivity growth. But the argument is just that technology is not that great yet, and so we'll have to wait for it. Oops, sorry. There's another argument that technology is not really feeding into productivity growth also because the firms that are benefiting from all of this new technology are kind of hoarding the benefits for themselves, and so it's not feeding through into the aggregate data. And then finally, there is an argument that it's just going to take a really long time. So even if the technology were that great, actually, by the time it's widely used enough to push up the aggregate data, it takes a while. So the one example we have is personal computers. So by the time personal computers were widespread, it still took 25 years for it to actually feed through into productivity data. The downside to that argument is that's the only real example that we have is personal computers. So I tend to think the tech is just not great yet, and that's part of the argument. So boosting your productivity growth is one way to fundamentally shift your potential GDP growth. I'm not too bullish on that side. The other way is to increase your labor force participation rate. And this is a chart for the US. To be fair, it looks a bit worse in the US than it does in the rest of the developed world. But you can see our labor force participation rate has been falling for over a decade. It's not a global financial crisis story. Necessarily, it started much longer before that. And if you disaggregate the labor force participation rate by gender, you can see that the male labor force participation rate in the US has been falling for decades. It's just the overall number has been buoyed by the female labor force participation rate, which has been going up, and now it's flattened out. So the overall figures are falling now. In the US, we like to slag off Japan for their incredibly low female labor force participation rate. Most people don't know that ours is actually lower in the US. So there's plenty of room for improvement on this front. Is it impossible for us to boost our labor force participation rate and therefore boost potential GDP growth? Not at all. We would need to see policies that, for example, encourage women to go into the workforce, child benefits, things like that. And for all of Ivanka Trump's efforts, I just don't see those policies coming down the line. The other way that's much more powerful, of course, is immigration. And unfortunately, in the US and across the rest of the developed world, we're all going in the wrong direction on that front. So if we're not going to boost our productivity growth and we're not going to boost our labor force, it's hard to see us fundamentally boosting our potential GDP growth rate. Now, that doesn't mean the US is going to grow by 2% every year. In the meantime, we've got a ton of stimulus coming down the line that should goose the system for the next 2 years. But I think if you're thinking in kind of medium to long-term terms, we're kind of stuck around our potential GDP growth. That doesn't mean we can't go into a recession, though. And so I'm going to highlight the risks. So I've told you my view, now I'm going to tell you all the ways I might be wrong. And I think there are a couple of things we should probably focus on. First of all, the Fed is taking the punch bowl away. The Fed's got real form on killing off this party. So this is just the last 13 rate hiking cycles and what they resulted in. You can see 10 of them resulted in recession. So history's not really on our side in terms of the Fed and not getting overeager, hiking too fast, and tipping us into recession. I do think that for the Fed's official mandates, one of the motivators for Fed policy is that rates are the policy rate is so low, and in the face of an average recession, the Fed cuts rates by 500 basis points. Well, we don't have anywhere near the room to do that at the moment. So as long as the Fed can get rates up so that there is room to cut in the next recession, I think they're motivated to. I don't see a late cycle surge in inflation coming, so I don't think that the Fed needs to worry about it. I do think that we have a more hawkish FOMC this year than we did last year because of rotating seats and new characters at the Fed. But I also think that politics could impinge on the Fed's actions. The Fed, to be clear, is an independent institution. It's the most independent central bank I speak to. But I have a hard time imagining the administration watching the Fed get really hawkish and essentially pouring cold water all over their tax bill and spending bill and fiscal stimulus measures without saying anything. So I do think that should moderate the Fed a little bit. But this is certainly a risk, a policy risk. I think leverage generally is an issue in the US and also in the rest of the developed world. So none of the developed economies know what they want to be when they grow up in terms of having a sustainable growth model if it isn't centered around leverage. Really quickly, because the consumption accounts for 70% of GDP, it's worth looking at the health of the US consumer. This is a chart just showing the relationship between savings and earnings. And you can see that as average hourly earnings go up, savings rate historically has also gone up as well, but more recently the average hourly earnings rate has gone up, albeit pretty tepidly, but the personal savings rate just keeps dropping and dropping and dropping, and that just suggests that maybe the US consumer is a bit tapped out. And if the US consumer has to start retrenching to repair their balance sheet, that would be a huge headwind for US growth. I don't think this is a screaming red flag. It's something worth watching, but I don't think that this will be the cause of the next recession. I think this will be, so that's non-financial corporate debt. And depending on what metrics you're looking at, non-financial corporate debt looks really worrisome or not. So this is just a chart showing corporate debt as a percentage of GDP. Unfortunately, the recession shading didn't come in here, but you can see the last three peaks essentially, or the last three peaks correlate with a recession. So you can see we're at a peak again. That suggests that maybe if we go into a recession, it'll be much harder for companies to actually go ahead and service their debt, and could cause the next recession. But if you look at corporate debt as a percentage or relative to corporate profits, it doesn't look worrisome at all. We're nowhere near our historical highs. So I think while rates are this low and profits are this high, we don't really need to worry. But both of those things are set to turn around. The Fed's only going one way on rates, and I think profits are probably going to go one way as inflation does continue to accelerate gradually. If you look at leverage for companies, if you look at it for the S&P 500s, this is just the aggregate data which most people are looking at, it doesn't look scary at all. Leverage looks pretty reasonable relative to historical figures. If you strip out all those companies that are sitting on tons of cash in tech and pharma, actually, you get a less rosy picture. So this is the same chart for the Russell 2000, which is essentially just small cap companies. So strips out the FANGs, gets rid of the pharma companies with tons of cash. You can see they look much more highly leveraged. So if you kind of look under the hood and kick the tires a little bit, actually a lot of these smaller firms are much more highly leveraged. And again, it's not a problem as long as rates are this low and corporate profits are pretty high. But both those things are going in the other direction, and it may become harder for them to service debt. The number of zombie companies in small cap is increasing. You can see there's been a big jump over the past 2 years, so that's a concern. And then also, we've been issuing up a ton of BBB credit. So BBB credit is the lowest of investment grade, and you can see we've got 2.5 times the amount of BBB credit than we had in 2010, kind of right after the financial crisis. We've got 5 times the amount that we had before the global financial crisis. And it matters just because if some of these companies start having trouble servicing their debt, then they'll be downgraded. And so you've got all this investment grade credit that's going to be downgraded into high yield. It'll completely flood the high yield market. So that's a worry as well. And just to highlight, it's not a worry as long as rates are really low, but rates are only going in one direction. So I think, they say history doesn't repeat itself, it rhymes. I think leverage is going to be a problem the next time around, and that it's going to be debt in the non-financial corporate sector. That'll be the real issue. It doesn't mean that we're going to get the global financial crisis we got last time, knock on wood. So I don't think the next recession means we're going to take out a bank. But I do think this is a reason to worry. Emerging markets are also concerned. So the US dollar has been, I think it's mostly dollar driven. The US dollar has been appreciating. I think the US dollar will continue to appreciate in the short term. That's the hardest call I have to make, I think, these days, is what's going to happen to the US dollar. In the short term, the US looks like it will be growing more robustly than the rest of the developed world, certainly. And also the Fed is more hawkish than most other major central banks, so that suggests that there should be upward pressure on the dollar. In the medium to long term, though, the US is blowing out its budget deficit. Also, we've got a current account deficit of around 3.5%. That should all put downward pressure on the dollar. And I do think if all central banks are stepping back from accommodation, then there are fewer funds flowing into the U.S., so that should put downward pressure on the dollar in the medium to long term as well. So medium to long term, I think the dollar will weaken. Short term, I think it could strengthen more, and that's a problem for emerging markets, partly because they're sitting on so much U.S. dollar denominated debt. So this is just the evolution of debt issued in various currencies. You can see euro denominated debt pretty much tapered off. Yen denominated debt has fallen a bit, but U.S. dollar denominated debt has been on a straight upward march. And this is just a breakdown by companies. So Chile, Turkey, Argentina, they're sitting on the most US dollar denominated debt. It's different for different countries. Turkey's got a lot of public debt issued in US dollars. Korea, which is fourth, has a ton of private debt issued in US dollars. But as the US dollar strengthens, it gets harder for them to go ahead and service. And on top of that, what most people don't realize is a bunch of these emerging market countries have been borrowing from China. So they've got loans from China that they're using to invest in the One Belt, or this infrastructure for the One Belt, One Road project. And all of that is off balance sheet. So this is the official debt figures, but on top of that, you've got to figure there's a bunch more debt out there that we don't even know about. Maybe the Chinese government has been writing some of it off, but these countries are more indebted than we realize, and a lot of it is in US dollars. On top of that, a bunch of these countries are invoicing trade in US dollars. Most people don't look at that. And some of that is oil, which is denominated in US dollars, but not all of it. So Under imports, you can see in the bar on the left is the amount of trade that we're doing with these other countries. So the dark green is the U.S. So we're EM countries that are trading a bit with the U.S. On the right, it's how much of their trade they're invoicing in U.S. dollars. It's far more than they're actually trading with the U.S. So a lot of their other trades invoiced in U.S. dollars. Same goes for exports. And so that's a concern as the U.S. dollar is getting is strengthening as well. And this is just a breakdown on countries that might be in particular trouble. And just shows the dark line is how much countries are invoicing in US dollars. The light one is how much they're trading with the US. Again, you can see they're invoicing much more in US dollars than trade would suggest. So that could become a problem as the US dollar strengthens as well. Trade, obviously, we've mentioned before, so I'll go through this really quickly. If you model a trade war, if you include all of the worst case scenarios for a trade war, and I've done this, a bunch of other shops have done this, you have to push on the model really hard to get any perceptible move in GDP or inflation for the US or China. So there are a lot of shops going out saying, you know what, look, it doesn't really matter, a trade war, it's not going to have a big impact on growth. Ignore that. Models are really faulty inherently, but they also don't show distributive effects, so some sectors will be hit really hard, some regions will be hit really hard. That's not captured in models. Models don't capture the disruptions to supply chains, which I think are the biggest impact of trade on growth. So I'm not as sanguine as some other economists are about trade wars. I think it will disrupt supply chains. I think the bigger impact will be in a loss of competitiveness rather than a feed through into inflation. I don't think most firms have the pricing power to pass through the costs of tariffs onto the end user anyhow, so it could eat into their margins and profits, and then you get the non-financial corporate debt issue that I've been warning about. I also think tariffs are a sideshow in terms of trade, particularly with China. I think at the heart of this is really the issue of who's going to be the global leader in artificial intelligence, machine learning, and quantum computing. Tariffs don't really get at that, but they're kind of a way in to niggle into that. So I think that's the main issue. It's baked into the Made in China 2025 strategy. It's central to China's medium to long-term growth strategy. It's also central to the US's long-term growth strategy insofar as we even have one. Neither side is going to back down on that. So I think these trade wars will probably get worse before they get worse. And you heard that right. They'll get worse before they get worse, I think. I'll skip this quickly, but just to show anybody who took Econ 101 and hated it, I'm sorry. This is just a chart from your intro economics class. It's Harberger's triangle. It's a complicated chart, but the important part is little triangles that are pink on the original one. I'm not sure if they look pink to you, but they're just the deadweight losses. So the theory is that if you impose any kind of rigidities in an economy, so that can be tariffs or subsidies. Some people benefit, so with tariffs, the government benefits, they get to collect more in tax revenues. The producers of whatever good has tariffs imposed on it, they benefit. But there are a bunch of losers too, so all the consumers of those goods are probably losers. And so net, you always get more losers than you get winners, and that's represented by those triangles, which are just called deadweight losses. So I think that we should worry about that in terms of trade wars as well. And then finally, I'll highlight a risk coming from outside. I don't know whether to call it Italexic, Italeave, Uscitalia. The idea is Italy leaving the Eurozone. Italy has a new government. It's comprised of the Lega and the Five Star Movement. Both parties are fairly populist. Both parties are pretty deeply anti-European. They backed off of rhetoric to leave the Euro in the run-up to the election, but both parties have suggested they would like to do so previously. The new government looks like it's carrying on full speed ahead to implement some of the policies that they campaigned on, which include a universal basic income, a flat tax, a VAT, scrapping VAT hikes, also withdrawing some of the pension reforms that were done in 2012. If you do a debt sustainability analysis for Italy, with or without that pension reform, it looks fundamentally different. So Italy's debt is just about sustainable with it. If they roll it back, it won't look sustainable at all. And this is just a chart showing how indebted Italy is, why it's important. It's fourth in the developed world in terms of debt to GDP. some countries in Europe can get away with blowing out their budget deficit and implementing fiscal stimulus measures without Brussels cracking down, even though there are strict rules about how big your budget deficit can get. And Spain's a great example of this. They've been doing it for years. The Spanish government is pro-European and can finesse things with Brussels. These two parties have particularly the Five Star Movement, they don't have much governing experience. They've already taken the government's taken a strong position on immigration. It's essentially poked German Chancellor Angela Merkel in the eye at a summit in late June. So they're showing like they're going to go in with all guns a-blazing, and that suggests that when they break the rules, Brussels probably won't let them finesse it. There will be a big clash. And then I think if Brussels cracks down on the Italian government, there will be questions in Italy about whether this European project is really worth it. And whereas the European project is really popular across Europe, and most countries, it's really not that popular in Italy. So it's not my base case scenario, but I do think there's a chance that a country leaving the Eurozone could come back on the table. Italy is the third largest country in Europe. If Italy were to actually leave, I think it would pose an existential threat to the European project, and I think there would be reverberations across global markets as a result of that. So that's something worth looking out for too. I will leave it there.
All right, so it looks like now we're kind of back on our 15 minutes for Q&A. I'll take the moderator's prerogative. We're in the 10th year of our U.S. economic expansion, second longest in U.S. history. None of the panelists seem to throw out the R word, so I guess that's a very positive thing with regard to a recession. So what would be your number one thing that kind of keeps you awake, or something you're monitoring closely that would make you concerned about a potential recession for the U.S. economy? Keep it short, just between each one of you.
Well, most of you know that we do have a probability model for recession, so we don't see anything in 6 to 9 months. But I would pick up on a couple of conversations we had last night, and you have to differentiate between if the yield curve becomes inverted, somehow there's a projection that we have a recession. I think from what I've heard so much in the last 2 to 3 weeks, the markets will react as if they're going to have a recession. And that is probably the biggest issue for me as an economist, is that the markets, as John Maynard Keynes said, is going to drive you broke before the actuality actually, happens. So again, that I would say, Bill, that's my concern, that the market's going to react to the perception that an inverted yield curve will lead to a recession.
Michael?
So my scenario is better growth in the second half. Trump holds the House. That leads to even more tariff and trade issues. At the same time, the Fed's tightening. That all gets to be too much. I think the recession is in the end of 19. Most people are out in 2021.
Okay, Megan, any thoughts?
Yeah, so non-financial corporate debt is my big worry, but I would also highlight we've got a ton of stimulus measures coming down the line for this year and next, but then we hit a bit of a fiscal cliff. And so if we have all these factors coming up at the same time we're hitting a fiscal cliff, that could lead to a recession. The only thing is 2020 is an election year, so the administration might be motivated to re-up on some of this stimulus leading up to the elections.
All right, great. Questions from the audience?
Bill, can I make a comment?
Go ahead.
I did very much appreciate the last point that Michael made, is the ability to set standards. When you're the leading nation, you can set standards, and I think I'll make 2 quick points. One, I believe we lost the opportunity to make standards when we got out of TPP right away. I think that was a huge mistake in terms of trade relations with Eastern Asia. And the second, and again, maybe Michael wants to comment on this as well, the dollar is a standard. I mean, so for us, we've benefited by having the dollar as a global standard for invoicing and pricing, measuring the prices of materials. And I believe, Michael, there was an attempt, or maybe a success, that China was starting to invoice things in yuan among their trading partners rather than the dollar.
No, that is true. I mean, it'll still take a long time, but for instance, the Iranian sanctions go on, Iran turns to China, makes an agreement, a side agreement, to sell more oil, priced in yuan, based on the price on the Dalian exchange. So from the Chinese point of view, this is a win because the Dalian exchange is now a more prominent, price caller, and the significant amount of trade is done in yuan, and they stick a finger in the U.S.'s eye all at the same time. It's a trifecta. So, I mean, a lot of that's going to go on. It's going to be decades before the yuan replaces the dollar. But that's not the issue. The issue is once you start that march, it doesn't stop. It just keeps going in one direction.
Okay, we have a couple of microphones, so if you want to raise your hand, we'll get a microphone over to you so everybody can hear your question. We got somebody right up here.
How does the big change in tax policy change your forecast?
So I think, I don't know if the microphone picked it up. How does a recent tax change affect the forecast?
So I think it's been a stimulus, so it's goose growth for this year and next. We should be growing well above potential GDP growth rate. But I think the big hope had been the expensing piece of the tax bill might encourage CapEx, which would boost productivity growth. I don't think it would ever really have fundamentally boosted CapEx spending. It might have accelerated some of it that was planned for further out anyhow. But as it turns out now, because of trade, it seems like a lot of firms are saying they're deferring and delaying CapEx. So it seems like trade is kind of offsetting the most powerful piece of the tax bill.
Yeah, I'll throw in something on that. Given the Chicago Fed, we have a very large industrial base for our district. And the response I was getting from many of our contacts was that, in particular for CapEx, the tax reform kind of sweetened the deal. So if you were kind of on the cusp, is what I was sensing, of making that investment, it kind of kicked you over to do it. But clearly, if you don't have a need to make that investment, a need for that machinery, that facility, you're not going to make it just because you got a good deal to put that money there. You need to actually use it. So demand has been the biggest driver for CapEx.
So the only comment I'm going to make is that you've known about that tax cut now for the better part of a year, and that's in the market. The stuff that's coming down the pipe is not in the market. So, a lot of people are saying, well, there's still a lot of tax stimulus to come, but you know about it. So it's in the market. So I'm more afraid of what's coming down the pipe than what's behind me.
Okay, another question.
This is a question in relation to John's comment about the inverted yield curve. The last time we had an inverted yield curve, it took, 18 months to go into recession. We didn't have Twitter back then. Is there some concern that Twitter, social media may speed that potential recession up?
Well, 2 points. In a recent piece we wrote, and anybody who wants a copy of the piece, except for Dylan, I'll send it to you. But I won't say anything to Ray. You already got it? But we did make the point that when you get the inverted yield curve and you look at the history of the United States since the 1970s, there's no consistent monthly period. It's not 12 months, it's not 6 months, it's not 18, so that creates a lot of problems. But I would agree with you. The ability of social media to communicate among all portfolio managers and venture capitalists that now we have an inverted yield curve. And oh, by the way, I think it's 26 basis points as they measure it today. Yes, could actually speed market reactions, as I think Twitter and Facebook and everything else has speeded market reactions to just about any piece of news that is out there compared to what it was 5, 10, 20 years ago. I would agree with that.
No, it's just behind you.
Okay. Yeah, Megan, this is for you. The trade wars, you said the situation could get worse before it gets worse. Which the question is, looking at all the industrial stocks in the last 6 months have gotten basically hammered, your big exporting. And it looks like they continue to weaken. Are they forecasting this getting worse as well?
Yeah, that's a good question. I think the shift in expectations has already happened in terms of fear that this will get worse. So I suspect a lot of the move has already been baked in. But my concern is that this will expand well beyond tariffs pretty quickly. So if we go ahead and impose these $200 billion in extra tariffs on China, they can't actually respond in kind. They just don't import enough stuff from us. So they're going to have to rely on other measures. And anecdotally, you're already hearing about compliance being jacked up for U.S. companies operating in China, licensing, red tapes being increased. And I think that's much more pernicious than just the tariffs. The actual trade tariffs that have been announced are kind of the economic equivalent of a mosquito bite, annoying, but not a game changer for either the US or China. But this other stuff, I think, is much more pernicious. And I'm not sure that the markets are baking that in.
So I was in China a month ago, and was on a conference with American Chamber of Commerce in Shanghai in conjunction with the EU Chamber of Commerce in Shanghai. And we went down to Ningbo and then across to Hangzhou. The day that we got on the bus, they rebooked us from a 5-star hotel where the conference was to a 3-star Chinese hotel a mile away. They did that the day of to the American bus, not to the 2 EU buses. This kind of stuff is going on a lot over there now. And it wouldn't matter if Xi Jinping himself were to come out and say, please stop that, because rank and file up and down the line know that America is now the enemy. And they're doing stuff about it. Well, we got $220 billion invested in China that's dropping in value because of this kind of friction.
Okay, I think we have time for one more question.
Hi, great presentations. Maybe could you each just share your point of view on the unemployment rate? And, we're at a pretty low point in it historically, and what kind of cyclical pressure you think that could put on wage inflation, and how that could adjust Fed policy, and or are we just going to run out of laborers, and that could lead to a slowdown and then bring into factor all these other issues you're talking about with corporate debt and earnings and et cetera.
So my very simple comment is that the labor market of today is not the same as the labor market 20, 30 years ago. I think we already heard that labor force participation rates are significantly changed. And again, picking up on a comment that, that Ray and I had, the challenge is, finding qualified workers in the right spot who will take the job, or unqualified workers who will stick around after the training and take that job. So I think the unemployment rate is not an indicator of where the labor market is compared to 20 or 30 years ago. I think, quite frankly, that presents a problem for the Fed to judge what exactly is full employment in the U.S. economy. But the challenge for us is finding skilled workers who can pass a drug test.
So I would argue that the connection people are looking for is low unemployment rate causes wage inflation, causes general inflation. I'm going to tell you to look at Japan. So low unemployment rate causes wage inflation, workers happy. The question is, does he go to the bank to borrow money? And was the same company that was happy enough to pay him higher wages also borrowing money for capital investment? The answer to both those questions in the United States now and Japan for the last 15 years is no. And with no bank borrowing, there's no inflation because there's no need for the Fed to create reserves.
Yeah, I'll just say, 50 years ago, the vast majority of what we consumed were goods. Goods producing sectors are high wage, high hour sectors. Now, 2/3 of what we consume are services. Services producing sectors are low wage, low hour sectors. So it makes sense that we're adding most of our jobs in the sectors producing the stuff we consume. But that also means we're adding most of our jobs in really low wage, low hour sectors for the most part. So we're not seeing upward pressure on wage inflation as we used to, given the level of unemployment.
Okay, I'd like to thank our panelists for a great opening session.